There is a ghost that haunts every decision you make with your money. It's a silent partner in your portfolio, a quiet saboteur of your success. It doesn't appear in any stock analysis or on any balance sheet, but its influence is responsible for more wealth destruction than any market crash in history. This ghost is your own mind. Specifically, it is a deeply ingrained evolutionary flaw in your thinking known as confirmation bias. It's the natural human tendency to search for, interpret, favor, and recall information in a way that confirms or supports your pre-existing beliefs. Once you decide you like a stock, your brain immediately goes to work, not as an objective analyst but as a loyal public relations agent for that decision. It builds a case, it gathers favorable evidence, it dismisses criticism, and it whispers sweet affirmations in your ear, telling you that you are in fact a genius. This process feels good, it feels smart, and it is the single most dangerous trap in the world of investing. But what if you could exorcise this ghost? What if you could flip a switch in your mind and adopt the one mental habit that separates the world's greatest investors from everyone else? Warren Buffett, a man who has built an empire of over $100 billion, not through complex algorithms or insider tips, but through superior thinking, does the exact opposite of what our brains naturally want to do. He does not try to prove his best ideas are right. He tries, with every ounce of his intellectual energy, to prove they are wrong. He actively seeks to destroy his own best ideas. This is not just a clever turn of phrase, it is the absolute bedrock of his investment strategy, a rigorous process of critical thinking that transforms investing from a game of guesswork into a discipline of science. By embracing this discipline, you don't just avoid a costly market mistake, you undergo a complete financial transformation. You learn to either build an unshakable, steel-cased conviction in your winning ideas, allowing you to hold them through the terrifying volatility that shakes everyone else out, or you learn to identify your own mistakes with ruthless clarity, selling them before they become catastrophic losses. This is the final promise, that by learning to kill your own ideas, you will finally give your portfolio a chance to truly live. This is the path to real financial education, the core of value investing, and the secret to not just playing the game, but to truly beating the market. Before you can even begin the rigorous, often painful process of trying to destroy your investment thesis, you must first have a thesis worth destroying. You cannot stress test a foundation of sand. This brings us to the first and perhaps most important pillar of the Buffett-monger approach to decision-making: the absolute necessity of operating within what they call a, quote, circle of competence. This isn't just a quaint metaphor, it is an intellectual fortress, a demarcated area of deep, specialized knowledge where you have a genuine, demonstrable advantage. It's the territory you know so well that you can not only identify the opportunities, but you can also see the subtle, hidden risks that an outsider would miss. Trying to seek disconfirming evidence in an industry you don't understand is a fool's errand. It's like proofreading a document in a language you don't speak. You might catch a typo, but you'll miss the fatal flaw in the argument. The story that best illustrates this principle of intellectual humility and its immense power is not one of a brilliant investment Buffett made, but of the thousands he famously refused to make. It's the story of how he sat out the single greatest speculative mania of his lifetime, the dot-com bubble of the late 1990s. Imagine the scene. It's 1999. The world is electric with the promise of a new digital age. Companies with .com at the end of their names, many with no profits, no clear business models, and sometimes no revenue at all, were seeing their stock prices explode. Day traders were becoming millionaires overnight. Financial news networks were a constant fireworks display of skyrocketing tickers. And in the middle of this euphoric party, Warren Buffett, the Oracle of Omaha, looked like a relic. He was a dinosaur. Berkshire Hathaway, his masterpiece of capital allocation, was dramatically underperforming the market. Its portfolio was filled with old economy stocks, insurance companies, consumer goods, utilities. Boring. Pundits and journalists openly mocked him. An infamous cover story in Barron's in 1999 was titled, "What's Wrong, Warren?" The article questioned if the world's greatest investor had lost his touch. if his simple value-based approach was obsolete in this new, fast-paced technological era. The pressure was immense. His own shareholders were questioning him. The entire world was telling him he was wrong. And what did Buffett do? He did nothing. He didn't chase the high-flying tech stocks. He didn't capitulate to the pressure. He simply and publicly admitted, "I don't know." He explained, time and again, that he simply did not understand the business models of these new technology companies. He couldn't, with any degree of certainty, project what their earnings or their competitive position would be in 10 or 20 years. He couldn't look at a company like Pets.com or Webvan and confidently map out its future cash flows. Therefore, they were outside his circle of competence. This wasn't a judgment on technology itself. He was famously friends with Bill Gates and deeply admired what Microsoft had built. It was a judgment on his own ability to value those businesses. He knew that if he couldn't understand the business fundamentally, he had no possible way of conducting a proper risk management analysis. He couldn't even begin to build a bear case because he didn't have the foundational knowledge to formulate a credible bull case in the first place. He was an expert in insurance, in brands, in railroads, industries with long histories and predictable economics. He could look at Coca-Cola and understand its moat. He could look at Geico and calculate its underwriting advantage. He could not do the same for Yahoo or a fiber-optic cable company. So he waited. And his patience was an act of supreme intellectual discipline. When the bubble inevitably burst in 2000 and 2001, the Nasdaq index lost nearly 80% of its value. Trillions of dollars of speculative wealth vanished. Those same pundits who had mocked Buffett were silenced. He hadn't predicted the crash. He had simply refused to play a game where he knew he was at a disadvantage. His focus on his circle of competence was not a constraint. It was his shield. It protected his capital, and the capital of his shareholders, from the devastating consequences of speculative mania. It was the ultimate act of wealth preservation, born not from a brilliant insight about technology, but from a humble insight about himself. The psychological principle underpinning Buffett's discipline is a powerful antidote to one of the most pervasive cognitive biases, the Dunning-Kruger effect. Coined in 1999 by psychologists David Dunning and Justin Kruger, this effect describes a phenomenon where individuals with low ability or knowledge in a particular domain tend to dramatically overestimate their own competence. In short, they are too ignorant to recognize their own ignorance. This is a terrifyingly common affliction in the world of stock picking. An amateur investor reads a few exciting articles about a biotech company developing a revolutionary new drug. They learn the jargon: Phase 3 trials, FDA approval, market exclusivity. Armed with this superficial knowledge, they begin to feel like an expert. They mistake familiarity with understanding. They believe they have an edge and proceed to invest a significant portion of their portfolio, completely unaware of the vast, complex landscape of clinical trial probabilities, patent law, insurance reimbursement schemes, and competitive drug pipelines that a true expert would consider. They are standing on the peak of what Dunning and Kruger called Mount Stupid. The circle of competence is a conscious, deliberate strategy to avoid ever setting foot on that peak. It is the practice of intellectual honesty. It requires you to draw a clear line in the sand between what you know with deep, intimate familiarity and what you don't. This isn't about intelligence. Buffett himself says the circle is not defined by its size, but by the clarity of its boundaries. A person can have a 160 IQ and still have a very small circle if they haven't dedicated the time to deeply learn a specific industry. Conversely, a person of average intelligence can develop a formidable circle of competence in a niche area, say the regional trucking industry or the market for dental supplies, through years of focused work and study. The Dunning-Kruger effect explains why so many people get wiped out in the market. They wander outside their circle, armed with dangerous overconfidence, and get picked off by the true experts, or, more often, by the sheer unforgiving randomness of a game they don't understand. Buffett's approach is the ultimate defense. It is a commitment to only swing at pitches in your sweet spot, a core tenet of any successful long-term investment strategy. So how do you, as an investor seeking financial freedom, define your own circle of competence? It requires a structured, honest self-appraisal. Here's an applied mental model, a blueprint for drawing your own intellectual boundaries. We can call it the 5 whys of competence. Step 1. Start with your profession and your passions. Make a list of the industries you have direct, hands-on experience with. Did you work in retail for a decade? In software development? In healthcare administration? Also list the subjects you are genuinely passionate about and have spent hundreds of hours studying out of pure interest. This is your raw material. Step 2. Apply the 5 whys. For each item on your list, ask yourself, why do I understand this industry? And then challenge that answer with another why, 4 more times. For example, I understand the restaurant industry. Why? Because I managed a restaurant for 5 years. Why was that experience valuable? Because I was responsible for inventory, staffing, and marketing. Why does that give me an edge? Because I saw firsthand how thin the margins are and how critical location and brand are to success. Why does that matter for investing? Because I can quickly spot a restaurant concept with unsustainable costs or a poor real estate strategy. Why is that the key insight? Because the market often gets seduced by growth stories, but I know that profitability in this sector is all about controlling mundane operational details. Through this process, you move from a vague claim of knowledge to a specific, identifiable investment edge. Step 3. The moat explanation test. Can you take a leading company within your circle and explain its competitive advantage, its moat, to a 10-year-old in 2 minutes? If you have to use complex jargon or convoluted explanations, you probably don't understand it as deeply as you think. A true expert can distill complexity into simple, powerful ideas. Could you explain why Costco's business model is so dominant, or why a specific medical device company has a lock on its market? If the answer is yes, that's a strong signal. Step 4. The disqualifier test. This is the final, crucial step. Go to a financial website and pull up the annual 10K report for a company in a sector you know nothing about. A semiconductor manufacturer, a reinsurance company, a mining operation. Try to read the business and risk factors sections. If it feels like you're reading a foreign language, if you can't form a clear picture of how the company makes money and defends itself from competition, then you have found the boundary of your circle. That feeling of confusion is not a sign of failure, it is a vital signal, a guardrail keeping you safe. This entire process is a foundational piece of financial education. It moves you from being a gambler to being a specialist, which is the first step toward professional-grade portfolio management. The antithesis of this disciplined approach, the path trodden by 99% of market participants, is the path of the story stock chaser. This investor operates with no circle of competence because they believe stories are a substitute for knowledge. They are drawn to companies with grand, world-changing narratives, curing cancer, revolutionizing transportation, building the metaverse. They hear a charismatic CEO on a podcast, get excited by a sleek product demonstration, and see a stock chart that is going up and to the right. This is all the due diligence they need. They buy the stock not because they understand the unit economics, the competitive landscape, or the regulatory hurdles, but because they want to be part of the story. They can't possibly seek disconfirming evidence, because their entire position is built on emotion and narrative, not on facts and analysis. When you ask them why they own the stock, they won't talk about return on invested capital or free cash flow yield. They will parrot the visionary talking points from the company's marketing materials. They fall in love with a future that may or may not exist, and they pay a current price that assumes it's a certainty. The landscape of financial history is littered with the corpses of these story stocks. Think of the genomics revolution in the early 2000s, 3D printing in the early 2010s, or the cannabis stock boom more recently. In each case, a compelling story about a massive new market led to absurd valuations for companies that had no sustainable competitive advantages. The story stock chaser buys at the peak of the hype and is left holding the bag when the narrative collides with the harsh reality of business economics. They are perpetually vulnerable because they have no analytical anchor, no deep knowledge to fall back on when the story starts to unravel. They are playing the market on its hardest difficulty setting, with no armor and no map. The direct financial connection between rigorously defining your circle of competence and your long-term returns is profound and multifaceted. Firstly, it dramatically reduces the number of unforced errors in your portfolio. Most major investment losses don't come from sophisticated risks gone wrong. They come from simple, avoidable mistakes made by straying into unfamiliar territory. By staying within your circle, you are eliminating the single biggest source of permanent capital loss. Secondly, it naturally leads to a more concentrated portfolio, which is a key trait of many of the world's best investors. When you only invest in things you understand deeply, you will find far fewer opportunities that meet your strict criteria. This is a good thing. It forces you to be patient and to only deploy capital when the odds are heavily in your favor. Instead of owning 50 stocks you barely understand, you might own 10 to 15 businesses you know inside and out. This allows for much deeper analysis and, ultimately, higher conviction. This concentration, when based on genuine competence, is what leads to market-beating returns. Finally, operating within your circle gives you the unique ability to identify and appreciate durable competitive advantages, the moats, that protect a business's profits from the relentless forces of competition. An outsider might see a successful company, but the insider, the person within the circle, understands the specific subtle mechanics of why it is successful and why it will likely remain so. This is the holy grail of value investing. It's this understanding that allows you to buy a great business and hold it for decades, letting the miracle of compounding do its work. This isn't just a defensive strategy for wealth preservation. It is the most reliable offensive strategy for building generational wealth. It is the solid ground upon which all sound decision-making must be built. Once you have established the solid ground of your circle of competence, the real work can begin. You have an idea, a potential investment in a business you understand deeply. The natural human tendency, the siren song of confirmation bias, is to start building a case for why you're right. You start collecting bullish analyst reports, focusing on the company's strengths, and imagining a bright future of growth and profits. The Buffett-Munger method demands you do the polar opposite. This brings us to our second pillar, the inversion principle. Popularized by the great German mathematician Carl Jacobi, who believed the best way to solve a difficult problem was to invert, always invert. This mental model is at the very heart of Munger and Buffett's approach to critical thinking. Instead of asking, "How can this investment succeed?" you must force yourself to ask, with brutal honesty, "How can this investment fail?" You stop looking for reasons to say yes, and you start an exhaustive, relentless search for reasons to say no. This isn't about being pessimistic. It's about being a realist. It's about stress testing your idea against every conceivable threat before you risk a single dollar of your hard-earned capital. The most transformative story of this principle in action within Berkshire Hathaway is the acquisition that fundamentally changed Warren Buffett's entire investment philosophy. It's the story of See's Candies. In 1972, Buffett and Munger were presented with an opportunity to buy See's Candies, a beloved family-owned chocolate company based in California. By this point in his career, Buffett was a master of what he called cigar butt investing. He looked for mediocre businesses trading at dirt-cheap prices. He would buy a stock trading for less than the value of its working capital, get one last puff of profit out of it, and then sell. His entire framework was built around finding statistical bargains. When he looked at See's, his cigar butt brain immediately balked at the price. The See family was asking for $25 million. The company's tangible assets, its book value, was only about $8 million. To pay $25 million would mean paying a huge premium, 3 times book value, for intangible assets like the brand name and customer loyalty. Buffett's initial reaction, his ingrained thesis, was this is too expensive, no. He was ready to walk away. But this is where Charlie Munger performed an act of intellectual jujitsu. He inverted the problem. Instead of asking, is this stock cheap based on its tangible assets? Munger forced Buffett to ask a different set of questions. Is See's Candies a truly wonderful business? Does it have a durable competitive advantage? Does it have pricing power that will allow it to raise prices year after year without losing customers? Is this a business we could happily own forever? Munger was actively looking for reasons to disprove Buffett's initial, "it's too expensive" thesis. He was forcing them to search for the no to the wrong question in order to find the yes to the right one. They began their due diligence with this inverted perspective. They realized See's wasn't just a collection of factories and inventory. It was a powerful brand that lived in the hearts and minds of its customers. Giving a box of See's chocolates for Christmas or Valentine's Day was a California tradition. This emotional connection gave the company immense pricing power. They could raise prices by 10% a year to cover inflation and then some, and customers would barely notice because the cost of a box of chocolates was a small, discretionary purchase tied to positive feelings. The business required very little new capital to grow, meaning it gushed free cash flow. After this inverted analysis, Buffett realized that paying $25 million wasn't expensive. It was a bargain. It was the chance to buy a phenomenal business at a fair price. They bought the company, and it has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, requiring very little additional capital investment. See's Candies, as Buffett himself has said, taught him a crucial lesson and rewired his brain. It showed him that it's, quote, far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And this monumental shift in his investment strategy, the one that made him a multi-billionaire, was all thanks to Munger's insistence on inverting the problem and actively trying to find the flaw in Buffett's initial bargain hunter's conclusion. The psychological principle that makes inversion such a necessary and powerful tool is the concept of motivated reasoning. This is a more insidious and complex cousin of confirmation bias. While confirmation bias is about seeking out agreeable information, motivated reasoning is about our unconscious tendency to process all information, regardless of its source, in a way that supports our desired conclusion. Our brain doesn't act like a scientist impartially weighing evidence to find the truth. It acts like a lawyer, hired by our emotions, whose sole job is to build the most persuasive case possible for what we already want to believe. If we want a stock to be a great investment, we will skillfully interpret high revenue growth as a sign of a massive market opportunity, while downplaying rising costs as mere quote, investments in growth. We will see a new product launch as a game changer, while dismissing a competitor's new product as irrelevant. Our reasoning is motivated by the outcome we want. Inversion is the conscious, deliberate act of fighting this internal lawyer. It's the decision to fire that lawyer and instead hire a devil's advocate for your own mind. It's about forcing yourself to argue the other side's case with equal or even greater vigor. When you ask, what could destroy this company, you are forcing your brain to temporarily abandon its preferred conclusion and engage in a search for truth, not validation. This process is uncomfortable, it feels unnatural, it creates cognitive dissonance. But it is the only way to break free from the powerful grip of motivated reasoning and see an investment with clear eyes. Every investor believes they are rational and objective, but motivated reasoning ensures that, without a conscious intervention like inversion, we are all just building elaborate, data-driven justifications for our gut feelings. To operationalize this principle, to make inversion a systematic part of your investment process, you can use a powerful mental model known as the pre-mortem. Developed by psychologist Gary Klein, this technique is a cornerstone of effective risk management and decision-making. It's a blueprint for inverting your way to a better investment thesis. Here is the step-by-step process. Step 1. Before you invest a single dollar, gather your research and sit down with your investment thesis. Now, fast forward in your mind. Imagine it is 1 year from today, and the investment has been an unmitigated disaster. The stock is down 50% or more. Your thesis is completely shattered. Step 2. For the next 30 to 60 minutes, Write a detailed, specific story of exactly what went wrong. Don't just say, "the economy got worse." Be precise. Did a new, low-cost competitor emerge from overseas and eviscerate your company's margins? Did a key patent expire, opening the floodgates to generic competition? Did the brilliant CEO, a key part of your thesis, unexpectedly resign? Did a change in consumer tastes make their core product obsolete? Did a key supplier go bankrupt, crippling their supply chain? Step 3. Get granular. Give the competitor a name. Describe the new technology that disrupted them. Speculate on the real reasons the CEO left. The more vivid and plausible you make this story a failure, the more effective the exercise will be. You are essentially writing the future history of your own investment failure. Step 4. You now have a document. This document is not a work of fiction. It is your new research roadmap. Your primary job, before you invest, is to investigate the probability of each of these failure scenarios you just invented. Your due diligence process is now inverted. You are no longer searching for reasons why the stock will go up. You are actively searching for evidence that these specific, pre-identified risks are real and present. This pre-mortem transforms your entire approach from a hopeful exercise in confirmation to a paranoid, rigorous exercise in risk management. The antithesis of the pre-mortem is the all-too-common behavior of the echo chamber investor. This is the individual whose process after buying a stock is to construct an environment that completely insulates them from any disconfirming evidence. Their first stop is a subreddit or a Facebook group dedicated to enthusiastic bulls of that specific stock. Here, they find a community of like-minded individuals who share their biases and reinforce their decision. Any positive news, no matter how trivial, is celebrated and amplified. Any negative news is immediately attacked and labeled as FUD, fear, uncertainty, and doubt, spread by short sellers or jealous haters. They meticulously curate their Twitter feed to follow only analysts and influencers who are bullish on their holdings. They dismiss critical reports from reputable sources as hit pieces. This investor isn't trying to understand their investment, they are trying to protect their ego. They have wrapped their decision in a warm, comfortable blanket of social proof and positive reinforcement. The echo chamber feels good. It provides a sense of community and shared purpose. But it is financially lethal. Because they are completely deaf to the bear case, they are perpetually surprised when things go wrong. When the stock begins to fall, they are unable to process the new information objectively. Their first instinct is to blame manipulation or to buy the dip, believing the thesis is still intact. They often average down on a fundamentally broken business, turning a manageable loss into a devastating one. They are the last to leave the party, holding a worthless stock certificate and a collection of old, bullish forum posts as a souvenir. The direct financial connection of the inversion principle, particularly through the pre-mortem technique, is its profound impact on your calculation of the margin of safety, popularized by Benjamin Graham, Buffett's mentor. The margin of safety is the principle of buying a security at a significant discount to its intrinsic value. This discount is what provides protection against errors in judgment or bad luck. By inverting your process and focusing obsessively on what can go wrong, you become naturally more conservative and demanding in your valuation. Your financial models will no longer be based on rosy, best-case scenarios. Instead, they will be stress-tested against the very failure scenarios you identified in your pre-mortem. What happens to my valuation if their main competitor does succeed? What if margins shrink by 2% due to new regulation? By building these potential negatives into your analysis, the intrinsic value you calculate will be lower and more realistic. This, in turn, forces you to demand a larger margin of safety, a lower purchase price, before you are willing to invest. You will buy fewer stocks, but the ones you do buy will be purchased at prices that offer you substantial downside protection. This is the absolute essence of professional risk management. It ensures that when you are right, you win big, and when you are wrong, you lose little. This discipline, born from the simple act of inverting the problem, is what separates sustainable, long-term wealth creation from a short, exciting, and ultimately disastrous trip to the casino. We have established the need for a circle of competence and the powerful technique of inversion. But to truly appreciate why these tools are not just helpful but absolutely necessary, we must confront the enemy head-on. We must dissect the ghost in the machine. This brings us to our third pillar, a deep, unflinching look at the confirmation bias trap itself. This isn't just a minor quirk in our thinking. It is arguably the most powerful and pervasive of all human cognitive biases. It is the master switch that controls our perception of reality, silently guiding us toward information that supports our existing beliefs while making us blind to anything that challenges them. It's the enemy within, the invisible hand that pushes us to fall in love with our stocks and hold them long after the original thesis has been shattered. To defeat this enemy, we must understand its origins, its tactics, and its devastating power. And there is no better way to understand its power than to examine one of the rare instances where it got the better of Warren Buffett himself, costing Berkshire Hathaway billions and serving as a painful public lesson in the dangers of falling for a good story. The year was 1993, and Warren Buffett made what he would later call one of his biggest mistakes, the acquisition of Dexter Shoe Company. On the surface, it looked like a classic Buffett investment. Dexter was a well-established, profitable shoe manufacturer based in Maine. It had a strong brand, a long history of success, and a reputation for producing durable, American-made footwear. It was precisely the kind of simple, understandable business that fit squarely within Buffett's circle of competence. He liked the management, he liked the product, and he fell in love with the story of a great American company. He was so confident, in fact, that he didn't pay for it with cash. He paid for it with Berkshire Hathaway stock, exchanging 203 shares, worth $433 million at the time, for the entire company. This was a crucial detail. When Buffett pays with cash, he is risking capital. When he pays with Berkshire stock, he is risking a piece of his life's work, a share in the collection of wonderful businesses he has spent decades assembling. It signifies the highest possible level of conviction. But somewhere in his analysis, the enemy within was at work. His positive initial assessment of Dexter, its great brand, its American heritage, likely created a powerful confirmation bias. This bias would have caused him to subconsciously filter incoming information, overemphasizing the evidence that confirmed his thesis, the company's history of profitability, while underanalyzing and dismissing the single most important piece of disconfirming evidence, the growing existential threat of cheap foreign competition. The world was changing, trade barriers were falling, and manufacturers in low-wage countries were beginning to produce shoes at a fraction of the cost that Dexter could. The durable competitive advantage that Buffett thought he was buying, the brand and its Made in America appeal, turned out to be a fragile sandcastle, easily washed away by a rising tide of globalization. Within a few years, Dexter's profitability collapsed. The business became worthless. But the cost to Berkshire was far greater than the $433 million he paid. The Berkshire stock he had traded for Dexter would, over the next couple of decades, become worth billions upon billions of dollars. He hadn't just traded cash for a worthless asset. He had traded a piece of a compounding machine for a melting ice cube. Buffett, with his characteristic honesty, has openly discussed this mistake many times. He admitted that he was wrong about the durability of Dexter's moat. He had failed to adequately stress-test his initial thesis against the most potent threat. He fell for the story, and the confirmation bias that came with it blinded him to the stark reality, proving that even the greatest investor of all time is not immune to this insidious enemy of rational decision-making. To understand why confirmation bias is so powerful, we have to look at its evolutionary origins. For our ancient ancestors navigating the dangers of the savannah, constantly second-guessing every belief was not a recipe for survival. If you formed the belief that a rustling in the tall grass meant a lion was nearby, it was far more advantageous to stick with that belief and run than to stop and seek disconfirming evidence. The person who acted on their initial confirmation survived. The person who conducted a rigorous, objective analysis often became lunch. Our brains are therefore wired for cognitive efficiency, not for absolute truth. We use mental shortcuts, or heuristics, to make quick decisions, and one of the most powerful shortcuts is to favor information that fits our existing mental maps. This trait is supercharged by a host of related biases. There's the quote, commitment and consistency bias, our deep psychological need to appear consistent with our past decisions. Once we buy a stock, admitting we were wrong feels like a personal failure, so we cling to the original decision even in the face of overwhelming negative evidence. There's the endowment effect, which causes us to overvalue things simply because we own them. A stock in our portfolio feels more valuable and has more potential than the exact same stock before we bought it. And there's the choice supportive bias, where we retroactively assign positive attributes to our choices to feel better about them. On a neurochemical level, every time we encounter a piece of information that confirms our belief, a positive news article about a stock we own, a price upgrade from an analyst, our brain rewards us with a small hit of dopamine, the pleasure chemical. We are literally addicted to being right. Confirmation bias isn't a character flaw, it is a fundamental feature of our neural architecture. Fighting it requires not just good intentions, but a systematic, structured process designed to counteract our brain's laziest and most self-serving instincts. To wage a successful war against this internal enemy, you need a practical weapon. You need a tool that forces a change in your behavior and your information diet. This is where we introduce an applied mental model, the disconfirmation journal. This isn't a digital tool, it's a physical notebook, a deliberate act of analog discipline in a digital world of distraction. Here's the blueprint. Step 1. For every single stock you own or are seriously considering buying, dedicate a section of the notebook. Step 2. On the left-hand page of a 2-page spread, you will write your bull thesis. List, in clear, concise bullet points, all the reasons you believe this is a great investment. What is the company's competitive advantage? What are its growth drivers? Why is it undervalued? This is the easy part. Step 3. The right-hand page is the sacred space. It is to be titled Disconfirming Evidence. Your new non-negotiable weekly task as an investor is to actively search for and fill this page. Your mission is to find the most intelligent, articulate, and data-driven arguments against your investment. Seek out the bearish analyst reports. Find critical articles from reputable financial journalists. Search for forums of unhappy customers or disgruntled former employees. Scour the competitors' press releases for signs of their success at your company's expense. Step 4. Here is the golden rule that makes the entire system work. You are not allowed to add any new information or ideas to your bull thesis page on the left until you have found and logged at least one new, credible piece of disconfirming evidence on the right-hand page. This rule short-circuits the confirmation bias loop. It forces you to spend as much, if not more, time engaging with negative opinions as you do with positive ones. Over time, this journal becomes an invaluable decision-making record. It provides a balanced, evolving picture of your investment, not just the rosy one your brain wants to see. It is the physical manifestation of a scientific, skeptical mindset, the key to truly objective stock analysis. The path of the 99%, the antithesis of this disciplined journaling, is the path of the top ticker checker. This individual's entire research and portfolio management process consists of compulsively checking the stock price on their phone, dozens or even hundreds of times a day. The stock price becomes their sole source of validation and information. If the ticker is green, it's a dopamine hit. It confirms their genius, reinforces their decision, and tells them everything is going according to plan. If the ticker is red, it's a source of anxiety, but this anxiety is quickly rationalized away. A red day isn't evidence of a potential flaw in their thesis. It's just market volatility, profit-taking, or, the ultimate bogeyman, short seller manipulation. They are not investing in a business. They are emotionally tethered to a flickering green and red number on a screen. Every piece of external news is filtered through this price-centric lens. If the company releases a stellar earnings report and the stock goes up, it's proof of a brilliant business. If the same report is released and the stock goes down, the report is ignored and the price action is blamed on, quote, market irrationality. They are incapable of objective analysis because their emotional state is entirely dictated by the random, short-term movements of the market. They have no anchor, no fundamental thesis to hold on to, so they are tossed about by the waves of daily sentiment. This behavior is a breeding ground for the worst investment decisions imaginable, a surefire way to buy high in a state of euphoria and sell low in a fit of panic. The direct financial connection between consciously fighting confirmation bias and your bottom line is most powerfully felt in your selling discipline. Confirmation bias, combined with its cousin, commitment and consistency bias, is the number one reason investors fail to cut their losses. It's the little voice that whispers, "It will come back," when a stock is down 20%, 30%, 50% or more. It's what causes people to cling to a losing position, hoping to just get back to even as the underlying business deteriorates before their very eyes. By systematically seeking out disconfirming evidence with a tool like the Disconfirmation Journal, you are pre-programming a logical sell trigger into your investment process. You are defining in advance what kind of information would invalidate your original thesis. When you see that very evidence, the evidence you were actively searching for, materialize, it creates a powerful cognitive imperative to act. The decision to sell is no longer an emotional admission of failure. It becomes the rational execution of a predetermined plan. This single skill, the ability to sell a mistake early and unemotionally, is what separates seasoned investors from amateurs. It is the essence of effective risk management. It prevents the small, inevitable mistakes that every investor makes from metastasizing into portfolio-destroying, catastrophic losses. By conquering the enemy within, you are not just improving your stock picking, you are installing a financial immune system that will protect your capital and allow it to compound for years to come. You now understand the terrain, your circle of competence, the strategy, inversion, and the enemy, confirmation bias. It is time to move from the abstract to the concrete. It's not enough to have the intention of seeking out disconfirming evidence. You need a rigorous, repeatable process for doing so. This brings us to our fourth pillar, the discipline of building a comprehensive bear case as the primary focus of your due diligence. For most investors, due diligence is a process of gathering reasons to buy. For the professional, it is the exact opposite. True due diligence is an exhaustive, forensic investigation into every reason the investment might fail. You must temporarily step into the shoes of the most cynical, pessimistic short seller you can imagine and build their case for them, with more passion and rigor than they would. Your goal is to construct an airtight argument for why your own best idea is, in fact, a terrible one. Only by doing this can you truly understand the risks you are taking. The definitive story of this red team approach in action is Buffett's legendary investment in American Express during a moment of existential crisis, a scandal that had convinced the entire market the company was headed for bankruptcy. The year was 1963. American Express was primarily known for its travelers' checks and charge cards, but it had a small, obscure warehousing division. This division's job was to certify and hold inventory for other companies, and then issue receipts against that inventory which could then be used as collateral for bank loans. One of their biggest clients was the Allied Crude Vegetable Oil Company, run by a charismatic fraudster named Tino De Angelis. The Allied company borrowed heavily against its massive inventory of salad oil, all held in giant tanks in Bayonne, New Jersey, and all certified by American Express's warehousing subsidiary. The problem was, the tanks were mostly filled with water. A thin layer of salad oil floated on top, fooling the inspectors. When the fraud was discovered, Allied collapsed, defaulting on $175 million in loans, an enormous sum at the time. The banks that had lent the money, holding worthless American Express receipts, turned to Amex for payment. Wall Street panicked. The market's bear case was simple and brutal. American Express was on the hook for the entire $175 million. This liability would wipe out the company's net worth and force it into bankruptcy. The stock cratered, falling by nearly 50% in a matter of weeks. The consensus was overwhelming: sell, sell, sell. This is the moment where Warren Buffett's genius for contrary thinking kicked in. Instead of accepting the market's bear case, and instead of just looking for reasons it might be wrong, he went out and did the work to actively try and prove the bear case was true. His central question was not about the legal liability, it was about the brand. The real risk, the thesis-destroying risk, was that this scandal would so tarnish the American Express name that customers and merchants would abandon its core products, the traveler's checks and the charge card. So he became an investigative journalist. He went to restaurants and hotels in his hometown of Omaha. He talked to the cashiers and managers, asking them if they'd seen any drop-off in the use of Amex cards. He visited banks and travel agencies, asking if customers were still buying travelers' checks with confidence. He even had his partners do the same in other cities. He was hunting for the disconfirming evidence. He was looking for the data that would prove the market's panic was justified. But he couldn't find it. Everywhere he looked, he found the opposite. He found that customers didn't connect the warehousing division's scandal with the trusted green card in their wallet. Merchants still valued the affluent customers the card brought in. The brand, the core of the business, was completely unharmed. He had tried his hardest to prove the bear case and had failed. This failure gave him extraordinary conviction. He also did the legal research and concluded that Amex's liability was likely far less than the market feared. Armed with this knowledge, he invested 40% of his entire investment partnership's capital, a massive, career-defining bet, into American Express stock. He was right. The company survived, the stock roared back, and the investment made him and his partners a fortune. It was a masterclass in using the market's bear case not as a reason to be scared, but as a research checklist for a phenomenal investment opportunity. The psychological principle at play here is known as red teaming, a concept borrowed from military and intelligence agencies. A red team is a group of people given the explicit task of thinking like the enemy. Their job is to challenge an organization's plans, strategies, and assumptions from an adversarial perspective. In a military exercise, the red team plays the role of the opposing force, trying to defeat the blue team, the home team. The goal is not to be disruptive for its own sake, but to expose vulnerabilities, uncover hidden risks, and stress test a plan in a safe environment before it's executed in the real world where the stakes are life and death. By formalizing the process of dissent, you remove the social friction and ego associated with criticism. The person playing the devil's advocate isn't being negative, they are performing a vital, designated role. When you build a bear case against your own stock idea, you are, in effect, creating a red team of one. You are giving yourself permission to be your own most ruthless critic. This mental framework is incredibly powerful because it institutionalizes skepticism. It makes the search for flaws a mandatory and valued part of your process, rather than an uncomfortable and unwelcome chore. For most people, their investment thesis is a fragile creation they want to protect. For the red teaming investor, their thesis is a hypothesis that must be subjected to the most brutal experiment possible. Only if it survives that experiment is it worthy of their capital. This is how you shift from making guesses to making professional-grade decisions. So how do you build a bear case that is as rigorous as the one Buffett built for American Express? You need a systematic blueprint. Here is a 5-step, full-spectrum bear case model for your due diligence. Step 1. Competitive threat analysis. Identify the company's top 3 competitors. These should include both established incumbents and, if applicable, disruptive startups. Your job is to become an expert on them. Read their last 3 annual reports. Listen to their quarterly earnings calls. Read their Investor Day presentations. Your goal is to understand their strategy so well that you could articulate from their perspective exactly why your target company is going to lose. What is their core argument against your company's moat? Step 2. Macroeconomic headwinds. List the top 3 macro trends that could pose a serious threat to this business. Is it rising interest rates, a shift in government regulation, a change in consumer behavior or demographics, a new technology on the horizon? For each trend, find the most pessimistic expert opinion you can and understand their argument in detail. Step 3. Internal execution risk. Go to the company's most recent 10K filing and find the Risk Factors section. Most investors skip this as legal boilerplate. You will treat it as a treasure map. Read every single risk listed. Your job is to identify the 3 most plausible and potent risks mentioned by the company itself. Then, go and investigate them. If they mention dependence on a single supplier, research that supplier. If they mention vulnerability to cybersecurity, research recent attacks in their industry. Step 4. Valuation deconstruction. Use financial data services to find the Wall Street analyst with the lowest price target on the stock, the biggest bear. Read their report. Do not dismiss it. Your goal is to understand their valuation model. What are their assumptions about future growth, margins, and interest rates? Try to rebuild their bearish model yourself in a spreadsheet. See if you can make their logic work. Step 5. Scuttlebutt. This is the shoe leather work. Go to online forums like Glassdoor and read reviews from former employees. Are there common complaints about management or culture? Search for customer review sites or Reddit threads. Are there emerging problems with product quality or customer service? This full-spectrum process creates a comprehensive, 3-dimensional map of all the potential landmines surrounding your investment. It is the definition of professional due diligence. The antithesis of this deep forensic work is the analyst report skimmer. This is the investor who believes they are doing their due diligence when, in reality, they are just collecting positive talking points. Their process begins and ends with a quick skim of a few bullish analyst reports. They look at the buy rating, they see the high price target, they read the summary paragraph filled with positive buzzwords like, quote, disruption, market leader, and long growth runway, and they consider the research complete. They never read the counterarguments. They never question the assumptions behind the analyst's financial model. They certainly never wade into the dense but crucial details of a 10K filing. Their entire process is designed not to uncover truth, but to acquire a quick and easy dose of confirmation that makes them feel confident in their decision. They are outsourcing their critical thinking to someone else, someone whose incentives and timeline may be very different from their own. This shallow approach provides a dangerous, false sense of security. It leaves them completely unprepared and emotionally blindsided when one of the many unexamined risks inevitably materializes. They didn't even know what landmines to look for, so they are shocked when one goes off under their feet. This is not an investment strategy. It's a form of financial malpractice performed on oneself. The direct financial connection between building a rigorous bear case and your returns is the discovery of asymmetric bets. An asymmetric bet is an opportunity where the potential upside is many multiples of the potential downside. These are the holy grail of investing, the opportunities that can truly transform a portfolio. And you can only identify them by having a deep, well-researched understanding of the downside. In the American Express example, the market was pricing in a downside scenario of complete bankruptcy, a 100% loss. Buffett's rigorous, bear case-focused research led him to conclude that the true, probable downside was far, far smaller. Maybe the company would have to pay out some damages, maybe earnings would be depressed for a year or two, but the core business was intact. With the downside understood and contained, the upside became massively asymmetric. He was risking a small, temporary business disruption for the potential to own a piece of a phenomenal, enduring franchise at a fire sale price. This is the secret. Superior stock picking is not about finding stocks that can only go up. No such thing exists. It is about finding situations where you have a very clear and high-confidence view of what could go wrong, and you are being more than compensated for taking that risk. The only way to achieve that clarity is by making the bear case, not the bull case, the absolute center of your stock analysis. It is the most reliable path to beating the market. We arrive at the final pillar, the ultimate payoff for all this difficult counterintuitive work. After you have operated within your circle of competence, after you have inverted the problem, after you have fought your own confirmation bias, and after you have built the most persuasive bear case possible and the investment idea is still standing, bruised but not broken, what you are left with is the most valuable asset an investor can possess: unbreakable conviction. This isn't the false bravado of the speculator or the blind faith of the story stock chaser. This is a deep, quiet, steel-cased confidence, born from a process of extreme intellectual trial by fire. This conviction is the psychological engine that allows you to not only survive, but thrive amidst the market's inevitable chaos and volatility. It is what allows you to hold on to your big winners, letting them compound into life-changing wealth while everyone else is panicking. The story that perfectly captures this final transformation is Buffett's steadfast ownership of the Washington Post Company during one of the most brutal bear markets in American history. In 1973, Warren Buffett began accumulating a massive stake in the Washington Post Company. He loved the business. It had a dominant, near-monopolistic position in a major city, giving it immense pricing power with advertisers. It was run by the brilliant and iron-willed Katharine Graham, whom he deeply admired. He had done his homework, he understood the business inside and out. He calculated its intrinsic value to be around $400 million, yet due to the prevailing market pessimism, its stock market valuation was a mere $80 million. It was a classic Buffett investment, a wonderful business trading at an absurdly cheap price. He invested over $10 million, a huge sum for him at the time, buying up more than 10% of the company, and then the market crashed. The bear market of 1973-74 was savage. The overall market fell by nearly 50%. And the stocks of media companies, including the Post, got hit even harder. Within a year or two of Buffett's purchase, the value of his investment had been cut in half. His $10 million stake was now worth around $5 million. Imagine the psychological pressure. The entire world is telling you that you've made a terrible mistake. The daily price action is a constant, screaming rebuke of your judgment. A lesser investor, one whose conviction was based on a shallow analysis or a hot tip, would have cracked. They would have sold, locking in a painful 50% loss just to make the pain stop. But Buffett did not sell. In fact, he was completely unperturbed. Why? Because his conviction was not anchored to the stock price. It was anchored to his deep, rigorous, and stress-tested analysis of the business. He had already considered the risks. He had already built the bear case. And nothing about the bear market had changed the fundamental reality of the Washington Post's dominant franchise. The stock price was a reflection of the market's manic-depressive mood, not a verdict on the company's intrinsic value. His prior work of trying to destroy his own thesis gave him the psychological fortitude to ignore the noise and trust his analysis. He held on. And that investment became one of the cornerstones of Berkshire Hathaway's success. His initial $10 million investment, which had been temporarily cut in half, would eventually grow to be worth over $1 billion. It was a 100-bagger, the kind of investment that defines a career. And it would have been completely impossible without the unbreakable conviction forged in the fires of his initial, skeptical due diligence. The underlying psychological principle that explains Buffett's ability to remain calm in the storm is the concept of an internal versus external locus of control. Developed by psychologist Julian Rotter, this theory describes the degree to which people believe they have control over the outcomes of events in their lives. People with a strong external locus of control believe that their fate is determined by luck, chance, or powerful outside forces. In investing, this is the person who sees the market as a mysterious, all-powerful entity. When their stocks go up, they feel lucky. When they go down, they feel like a victim of the market's whims. Their emotional state is entirely dependent on external validation from the stock ticker. In contrast, people with a strong internal locus of control believe that their own actions, decisions, and abilities are the primary determinants of their outcomes. The entire process we have been discussing, the rigorous due diligence, the inversion, the building of the bear case, is a mechanism for shifting your locus of control from external to internal. When you have done this work, your conviction is no longer derived from the market's opinion, it is derived from the quality of your own research. You are no longer a passenger on a chaotic sea, you are the captain of your own ship, navigating with your own map. Market fluctuations are no longer seen as a judgment on your intelligence, but simply as weather, sometimes stormy, sometimes calm, but ultimately irrelevant to your destination, as long as your ship, your thesis, is sound. This internal anchor is the source of the emotional resilience required for long-term investing success. To make this psychological shift a practical reality, you can create a final, powerful tool, the one-page conviction checklist. This document is the culmination of all your research, designed to be your steadfast guide during moments of market panic. Here is the blueprint. Step 1. After you have completed your full-spectrum bear case and have decided to invest, take out a single sheet of paper. At the top, write the thesis in one sentence. Distill the entire bull case down to its most powerful, elemental truth. For example, for the Washington Post, it might have been, "The Post is a near-monopoly provider of essential information in a major capital city, giving it a durable moat and immense pricing power." Step 2. Below that, create a section titled "The 3 Killer Risks." List the 3 most potent, thesis-destroying risks that you identified during your bear case research. These are the things that genuinely worry you. For the Post, it might have been the rise of television news, a prolonged economic depression in the D.C. area, or a catastrophic failure of management. Step 3. This is the most crucial part. Next to each risk, create a subsection called the invalidation signals. For each of the 3 risks, define a clear, observable, and preferably quantifiable signal that would tell you the risk is no longer just a possibility, but is actively materializing. For the risk of television news, an invalidation signal might be, if newspaper circulation numbers in the D.C. metro area decline by more than 10% for 2 consecutive years, my moat thesis is threatened. Step 4. Print this one-page document and put it away in a physical file or a drawer. Now, when a market crash inevitably happens and your stock is down 30%, your instructions are simple. You are forbidden from watching the news or checking the stock price. Your only job is to calmly take out this one-page checklist and ask a single question. Have any of my predefined invalidation signals been triggered? If the answer is no, then the price decline is just noise. The market is offering you a gift, the chance to buy more of a wonderful business at a cheaper price. If the answer is yes, then you have a genuine reason to reconsider your position and potentially sell. This simple document is the ultimate tool for disciplined, unemotional decision-making, the practical key to achieving financial freedom by overriding your own worst instincts. The antithesis, the path of the 99%, is the path of the weak hands investor. This individual's conviction is a mile wide and an inch deep. They buy a stock based on a flimsy premise, a tip from a friend, a bullish headline, or a chart that looks good. Because they have done no deep skeptical work, they have no intellectual anchor. The stock price is their only measure of success. The moment the stock begins to fall, panic sets in. They have no conviction checklist to consult, no fundamental analysis to fall back on. All they see is red on the screen, and all they feel is the fear of losing money. This fear is magnified by the scary headlines and the panicked chatter on social media. With no internal locus of control, they are completely at the mercy of the external chaos. They sell at or near the bottom, crystallizing a temporary paper loss into a permanent real one. Often, they then watch in agony as the stock, whose underlying business was perfectly fine, recovers and goes on to new highs. They vow never to make that mistake again, But because they don't fix their process, they are doomed to repeat it. They are forever caught in a cycle of buying high on greed and selling low on fear, the guaranteed path to the destruction of wealth. Their portfolio management strategy is not a strategy at all, it is simply a series of panicked reactions to market noise. The direct financial connection between building unbreakable conviction and your net worth can be summarized in one word: compounding. The greatest fortunes in the history of the stock market were not built by flitting in and out of stocks. They were built by identifying a small number of truly exceptional businesses and holding them for very, very long periods of time, years and often decades. This is the only way to harness the almost magical power of compound interest, where your returns begin to generate their own returns in an accelerating, exponential curve. The process of trying to destroy your own ideas and failing is the only psychological mechanism that enables an investor to do this. It is the only way to gain the emotional fortitude to hold a stock through 50% drawdowns, through recessions, through wars, and through panics, which are all normal and recurring features of a long-term investment journey. Let's consider the mathematics. An investor who buys a great company and sells it after a 50% gain does well. But an investor who holds that same company for 20 years as it grows at 15% per year will see their initial investment multiply by more than 16 times. The difference over a lifetime of investing is not a few $1,000s. It is the difference between a comfortable retirement and true generational wealth. Unbreakable conviction is not just a defensive tool for surviving volatility. It is the ultimate offensive weapon for capturing the explosive, long-term power of compounding. It is the final essential ingredient for a successful investment strategy, the true secret to beating the market and achieving lasting wealth preservation. You have just been given a powerful weapon. This framework of defining your competence, of inverting the problem, of battling your own biases, and of building conviction through skepticism is not just a collection of investing tips. It is a fundamental upgrade to your mental software, a new operating system for making rational, high-stakes decisions, not just in your portfolio but in your career and your life. You've invested your time and attention, and in return, you've acquired a tool that can protect and grow your capital for the rest of your life. But it's crucial to understand that this tool, as powerful as it is just one piece of a much larger, interconnected system of thinking. The world's greatest investors don't rely on a single trick. They wield a full arsenal of mental models. They understand that a principle like seeking disconfirmation is deeply connected to other concepts, like understanding business moats, calculating intrinsic value, and thinking in terms of probabilities. Mastering one model in isolation is like learning a single, powerful karate chop. It's effective, but it's not a complete martial art. True mastery comes from understanding how each move flows into the next. The journey doesn't end here. There is a map to this full arsenal, a way to see how these powerful ideas link together to form a coherent philosophy of success. The video that is now appearing on your screen is the next piece of that map. It is the link that connects this principle of rigorous risk management to the art of identifying extraordinary opportunities. It takes the defensive mindset we've just built and shows you how to use it as the foundation for a powerful offensive strategy. The choice you face right now is not simply whether to watch another video. It's a choice about your own identity. Are you content to be a passive consumer of financial tips? Or are you on a deliberate journey to become a true student of the game, a capital allocator who operates with a superior set of mental tools? If you are serious about continuing that ascent, about completing your mental arsenal, then the next step is clear. The missing link awaits. Click and continue the journey.